Why is it crucial to understand financial ratios for banking interviews? Well, having a solid grasp of these ratios can set you apart from other candidates, and here's why. Firstly, we have the net interest margin, or NIM. This ratio is a clear indicator of the difference between the interest income generated by banks and the amount of interest paid out to their lenders relative to their interest-earning assets. It's a direct reflection of a bank's ability to manage its loans and investments relative to its debts. Next up, the efficiency ratio. This ratio compares a bank's operating expenses to its revenues, providing a snapshot of how efficiently the bank uses its resources to generate profits. The lower the ratio, the better the bank's efficiency. Then we have the return on assets, or ROA. This ratio measures a bank's profitability in relation to its total assets. It gives an insight into how effectively a bank is using its assets to generate profits. Similarly, the return on equity, or ROE, measures a bank's profitability, but this time relative to its shareholders' equity. This ratio is a key indicator of a bank's financial health and its ability to generate returns for its shareholders. The loan-to-deposit ratio is another significant ratio. It indicates what portion of a bank's deposits have been lent out as loans. A higher ratio suggests that the bank is lending more than it is receiving in deposits, which could potentially signal a liquidity risk. Next, the capital adequacy ratio, or CAR, measures a bank's capital in relation to its risk-weighted assets. It's a crucial ratio for assessing a bank's ability to absorb losses and meet regulatory requirements. The non-performing loan ratio, or NPL ratio, shows the percentage of a bank's loans that are in default or close to default. A higher NPL ratio indicates a higher level of risk for the bank. The loan loss provision ratio is another key ratio. It indicates the proportion of a bank's income that's set aside to cover potential loan losses. A higher ratio suggests that the bank is more conservative in its approach to risk management. The Tier 1 capital ratio measures a bank's core equity capital relative to its total risk-weighted assets. This ratio helps assess a bank's financial strength and its ability to absorb losses. Lastly, the net interest income to total income ratio shows the proportion of a bank's total income that comes from net interest income. This ratio is a good indicator of a bank's income diversity. To summarize, understanding these financial ratios can give you a competitive edge in banking interviews. Each ratio provides valuable insights into a bank's performance and financial health, and being able to discuss them confidently could potentially impress your interviewers.